Three words: crust like cardboard. This phrase, or variations of it, appeared in thousands of online reviews for Domino's Pizza in late 2008. One particularly brutal example from a frustrated customer in Phoenix, Arizona continued, "The sauce is like ketchup and the cheese is rubber." This wasn't an isolated incident. Across the country, Domino's customers were saying the same thing. The pizza was, to put it mildly, terrible. Why would a multi-billion-dollar company let its core product become a national punchline? And why would they then go on national television to admit it? The answers to those burning questions reveal a hidden strategy far more audacious than simply making a better pizza. I dug through their annual reports, investor calls, and marketing archives from that decade, and what I found explains how Domino's survived a near-death experience, reinvented itself, and exploded into a $17 billion global empire. The story of Domino's improbable rise comes down to three radical, often counterintuitive decisions. Before we get to the shocking ad campaign, we need to understand just how dire things were for Domino's. By the late 2000s, the company, founded in 1960, was struggling. Its stock price, which had hovered around $25 in 2007, was collapsing. By November 2008, it dipped to below $10 a share, according to NASDAQ historical data. The problem wasn't just the recession, it was far more fundamental. Customer satisfaction surveys, like those from Brand Keys in 2007, consistently ranked Domino's at or near the bottom of national pizza chains. Competitors like Pizza Hut and Papa John's were eating into their market share, which had been steadily declining since 2005. Domino's was losing money, losing customers, and critically, losing its identity as a convenient, reliable pizza option. They were trapped in a race to the bottom, cutting costs, which only made the product worse. This wasn't just a bad quarter, it was an existential threat to the company, so the stage was set for a desperate gamble. In late 2009, then CEO Patrick Doyle took the helm. He knew traditional marketing wouldn't work. The problem wasn't perception, it was reality. Their pizza was bad and everyone knew it. Doyle made a radical decision: they would admit it. This wasn't a whisper campaign or a subtle rebranding. This was a full-frontal assault on their own product, broadcast nationally. The Pizza Turnaround campaign, launched in December 2009, featured actual Domino's chefs and executives reading unvarnished, brutal customer reviews aloud. They showed comments like, "The crust is like cardboard, sauce tastes like from a can, and it's the worst pizza I've ever had." Doyle appeared in the ads, looking directly at the camera, and promised change. He announced a completely new pizza recipe, from the crust to the sauce to the cheese, saying, "We hear you, America." It was an unprecedented act of corporate humility and transparency, designed to shock and disarm a cynical public. The campaign instantly grabbed headlines, creating a whirlwind of media attention. Some praised the honesty, calling it a brave, refreshing move. Others, however, were deeply skeptical, dismissing it as a publicity stunt. Investors were divided. While the stock initially saw a small bump, it remained volatile, reflecting uncertainty about whether a new recipe and a mea culpa could truly save a dying brand. Early sales figures, reported in Q1 2010, showed a mixed bag. While some markets responded positively to the novelty, the overall lift was not immediately transformative. Many believed that even if the pizza was better, Domino's had fundamentally damaged its reputation beyond repair. After all, what company willingly broadcasts its own perceived failures to millions? But the truth is, improving the pizza itself, while critical, was only the first step. The real revolution was happening quietly, behind the scenes, long before the televised admissions. As early as 2007, Domino's leadership recognized that the internet was reshaping consumer behavior. People wanted convenience, and they wanted it fast. The company began a massive, often overlooked, investment in its digital infrastructure. They shifted away from the traditional phone call model, pouring millions of dollars into developing a robust online ordering system. By 2008, well before the Pizza Turnaround campaign, online orders accounted for roughly 10% of their sales, according to the company's annual reports. This figure would surge dramatically in the years that followed, proving that the future of pizza delivery wasn't just about taste, it was about frictionless digital access. Once customers were ordering online, Domino's saw another opportunity to innovate. Delivery, for most consumers, was a black box. You placed an order, then you waited, wondering when your food would arrive. In 2008, Domino's launched the Pizza Tracker. This groundbreaking tool allowed customers to follow their order in real time, from the moment it was placed to when it entered the oven, was boxed, and left for delivery. It was a simple idea with a profound psychological impact. The Pizza Tracker didn't just provide information, it transformed the waiting experience. It made delivery feel transparent, reliable, and even a little bit fun. It gamified the process, giving customers a sense of control and engagement that no other pizza chain and few other food companies could match at the time. This wasn't just about making better pizza or easier ordering. Domino's was fundamentally changing what kind of company it was. CEO Patrick Doyle, during a 2014 investor call, famously stated that Domino's was an e-commerce company that happens to sell pizza. They realized their core competency wasn't just food preparation, but efficient, last-mile delivery logistics powered by technology. They invested heavily in building an in-house tech team, recruiting hundreds of software engineers and data scientists. They developed proprietary point-of-sale systems, supply chain management tools, and sophisticated data analytics platforms to optimize every step of the delivery process. This repositioning was radical. They weren't just competing with Pizza Hut anymore. They were building an operation that, in its digital efficiency and delivery speed, began to resemble an early-stage Amazon or a specialized Uber Eats, long before those companies dominated the market. The market, initially skeptical, began to take notice as these strategic shifts directly impacted their bottom line and investor confidence. In late 2008, Domino's stock was trading at a paltry $8.50 per share. By the end of 2010, after the pizza turnaround, and as digital adoption began to accelerate, it had climbed to over $17, but that was just the beginning. The stock soared past $50 by 2013, then over $100 by 2015. By 2018, it was trading above $300, and by 2021, it briefly touched $550 a share. This represented an astounding return of over 5,000% in just over a decade. The company's market capitalization exploded from less than $1 billion in 2008 to over $17 billion by 2021, according to market data from Yahoo Finance. Domino's became one of the best-performing restaurant stocks of the 2010s, dwarfing the returns of many tech giants. The success wasn't accidental. It was built on an expanding ecosystem of digital tools and audacious bets. Domino's continued to innovate, introducing Anywhere Ordering in 2015, which allowed customers to order pizza through smartwatches, smart TVs, Twitter, text messages, and even by simply sending a pizza emoji. This wasn't just a gimmick. It was a strategic move to be present wherever and whenever a customer might decide they wanted pizza, further reducing friction and capturing impulse buys. They also heavily invested in their loyalty program, Piece of the Pie Rewards, launched in 2015, which incentivized repeat purchases and provided invaluable data on customer preferences and habits. Each new tech initiative reinforced their image as a tech-forward company, cementing their lead in the digital delivery space. Beneath the surface of seemingly simple pizza delivery lies a relentless, data-driven war for every customer interaction. Domino's understood that in a crowded market, convenience and personalization were the ultimate weapons. Their digital platform allowed them to collect vast amounts of data on everything from peak ordering times to popular toppings, delivery routes, and individual customer preferences. This data enabled them to optimize staffing, manage inventory, personalize promotions, and constantly refine their user experience. It created a powerful feedback loop, making their service faster, more reliable, and more tailored with every order. This deep integration of technology into every aspect of their operation created a formidable competitive moat, making it incredibly difficult for rivals, even those with arguably better pizza, to catch up. Domino's proved that sometimes, the best way to win isn't by selling the best product, but by becoming the best at getting it to you. But the tech advancements weren't just about consumer-facing convenience. They were also a critical engine for internal efficiency and franchisee profitability, which became the true fuel for Domino's explosive growth. Their proprietary point-of-sale system, named Pulse, which they developed and continually refined since its initial rollout in 2003, wasn't just a cash register. It seamlessly integrated inventory management, labor scheduling, and delivery route optimization, providing real-time data to individual store owners. This level of operational insight and control, previously uncommon in the fast food franchise world, allowed franchisees to precisely track costs, manage staff more effectively, and significantly boost their local store's performance. This standardized yet powerful tech stack meant Domino's could offer an incredibly attractive, hyper-efficient business model to prospective franchisees. While competitors like Pizza Hut or Papa John's often relied on fragmented or third-party solutions, Domino's provided a turnkey digital infrastructure. This made opening and running a store less complex and more predictably profitable, especially as the company scaled. Between 2010 and 2020, Domino's added over 1,500 net new stores in the United States alone, expanding its footprint significantly while many rivals stagnated. This wasn't just about quantity. Average unit volumes for U.S. Domino's stores soared from approximately $800,000 in 2008 to nearly $1.4 4 million by 2020. This substantial increase in revenue per store, driven by digital ordering and operational efficiency, directly translated into higher profits for franchisees, fueling further investment and rapid expansion. It created a powerful virtuous cycle that cemented their market dominance. This commitment to empowering their operators through technology was so fundamental that it eventually transformed Domino's into the undisputed leader of the pizza world. By 2017, they officially surpassed Pizza Hut to become the largest pizza company globally by store count, a position they continue to hold with over 20,000 locations worldwide today. Their relentless focus on digital innovation means that in the US, over 75% of all orders now flow through their apps or website, creating a seamless, data-rich transaction process. Ultimately, this efficiency allows Domino's to sell over 3 million pizzas across the globe every single day. Subscribe to Margin, and the next video is waiting for you on screen right now.